Welcome back, everyone, to the Biz Beat by SVA, where we keep business owners informed on the latest in tax, policy, and financial strategy. I'm Lee Schwartz, Director of Business Development and Sales at SVA Certified Public Accountants, joined as always by our tax partner and firm president, Eric Trost. Eric, how are you? Are you getting ready for Halloween? You have a costume all picked out?
I'll be in Disney for Halloween.
Oh, is that like a big thing? It's probably a big thing down there.
It's a big thing for my family. They really enjoy it down there. And yeah, it does tend to get fairly crowded down there.
Does everybody dress up?
Nobody dresses up anymore. We're all too old for that. But we're not too old for the free candy.
Okay, there you go. Well, that'll be fun. That must be really nice and quite a bit warmer than here. And finally, it'll be getting cool here in Wisconsin. So,
Yeah.
well, hey, before we get started, I just want to let all of our listeners know, if you want updates and explanations on the One Big Beautiful Bill Act, which we talk about all the time, visit sva.com/OBBBA. It's your go-to resource for summaries, FAQs, recorded webinars, upcoming webinars, all sorts of fun information there. But Eric, let's jump right in this week. There was some new guidance that just recently dropped from the IRS about auto loans. I know we've talked about this a little bit, but I think we've got some clearer understanding of where this is at. You want to bring our listeners up to speed?
Sure. Well, let's do a recap first of what the new interest expense is as allowed deduction for an auto loan. So prior to the One Big Beautiful Bill Act, prior to OBBBA 3, automobile, when you purchased an automobile and you took a loan out, the interest expense from that was not deductible. It was called personal interest, kind of like credit card interest. There's other types of interest not deductible, as opposed to the interest that was allowed as a deduction, mortgage interest. So when you purchased a house, the interest on that was deductible. So what changed with OBBBA is that auto loan interest, to an extent, is now also deductible. So this can be essentially deducted from your income to get to calculating your income tax. The deduction is up to $10,000. So $10,000 of auto loan interest is available as a deduction. So that's the cap. And it also phases out for those that are making too much income. And in this case, and the IRS and the government have a lot of flexibility when they say too much income. Sometimes it's a big number like 400,000. Sometimes it's a small number like 30,000. In this case, they kind of went middle of the road. The deduction starts to phase out for a single person at 100,000. So if they make over 100,000, they start to lose the ability to take that deduction. And for a married couple, it starts to phase out at 200,000. So a married couple making up to 200,000 will have the full $10,000 cap available to them. But once they make over 200,000, that deduction cap starts to phase down and then goes down eventually to zero. So auto loan interest is now deductible, subject to the cap of $10,000, subject to those income limits. Also, the vehicle that's purchased that you are paying the auto loan interest on, it has to be assembled in the United States. So you might think, oh, okay, that's what are the U.S. car companies? We've got Ford and we've got GM. We've got American Motors. Oh, wait, I think they're gone.
That's very timely. Right.
Right. Let me check the press clippings on that. They might not be here anymore.
Okay.
So you've got those companies that do have assembly, not always final assembly in America, so that doesn't necessarily count. But actually a lot of foreign cars that are described as foreign cars or foreign companies, Kia, Lexus, Toyota, they have assembly plants in the United States. So it could be that foreign car is also assembled in the United States and does get this deduction. So again, the auto has to have final assembly in the United States, and that doesn't automatically disqualify a foreign car. And by the way, does not automatically mean that your GM or your Ford is assembled here, because it might be assembled overseas. So you really have to check. And there's a couple lists out there. The IRS doesn't have their final list out yet, but you really have to check where the final assembly of this is. And there are places to search on the internet to say, hey, is my car X brand assembled here in the United States. So, assuming you've got that car assembled in the United States, you can take that auto loan deduction interest, and it's going to be subject to the caps we said before, the $10,000, and then the phase outs of the income. How do you know what interest you paid? Most people don't track that. That's what the guidance today addresses. The IRS said, hey, the lenders, the borrowers, you have to get information to those who are paying the interest and tell them how much interest they paid on their auto loan during the year. And even though this bill was signed in July, remember that Trump wanted to get this signed by July 4th, which he did. He signed it, I think it was July 3rd. So he got the bill signed by his deadline date. This interest is deductible for the full year. So starting in January. So if you bought the car in January, you get this auto loan interest deduction. So how do you know how much you paid? Well, the way to know how much you paid is on your mortgage interest is the lender tells you. They send you a form at the end of the year. Hey, you've paid us this much in mortgage interest. So that's how you know what to deduct on your tax return. The same thing is now true for auto loan interest. So the bank is going to send you, or the bank or lender, whoever it is, should send you a form that says this is how much you paid in auto loan interest. They don't necessarily have to send you a form, though. That's one of the options. They can actually just make it available on a website where you can log in and look it up. So the IRS is giving the lenders a lot of flexibility as far as how they communicate that information to you as the borrower. How much interest did you pay? You can go to the website for the IRS, basically saying, hey, you can do this on a website, or you can send a form or some other kind of communication that gets to the person who is paying the loan. You can send them a statement and say your year-end balance is this, and you paid total interest during the year of this number right here. By getting this form, that again, that doesn't automatically mean it's a deductible amount. The lender doesn't know about the final assembly. The lender doesn't know about your income. The lender doesn't really even care about the cap. All they're really doing is sending you information on how much interest you paid on that auto loan. Then you've got to take that and run it through these tests to see, is this a deductible amount? Do I have a car that's assembled here in the United States? Am I over or under these cap limits for the income phase outs? And then you get up to the $10,000 deduction. So you'll get that information. Again, that doesn't automatically mean you get a deduction. It means that's your starting place to see, do you get a deduction? That's how much you paid.
And Eric, I would imagine that $10,000 deduction then is per year. That's not per vehicle or over the course of the loan. That is just, hey, if you qualify, if your car was assembled in the U.S., if you're under those income thresholds, then you can deduct up to $10,000 of that interest.
That's right, but it's every year. So if you pay interest this year, you can pay interest next year on the same vehicle. If the loan's not paid off, you'll be paying interest over the course of time. So, depending on the cost of the vehicle, and it's insane these days, you could be paying interest for 7 years, is what the dealers are doing. So you could have this deduction a long time. Well, now that I say that, okay, the deduction could be there a long time if they extend it. This is a limited time only deduction. It's 2025 this year through 2028. So right now it covers that period of time. If you're paying interest after 2028, it's no longer automatically deductible. It'll be addressed, I'm sure, at some point in the future when this phases out. Is this something that's extended or not? Is this a rule they're going to extend or not?
Right. And I think I just heard in the last week or two, we just passed a big threshold where the average new car sold in the United States is now over $50,000. So with current interest rates and that number, there's a lot of interest being paid.
Yeah, that's right. That's right. It's you almost have to mortgage your house to buy a car sometimes.
Exactly. Well, great. All right. So that's super helpful. Eric, let's move on to talk about something that happened last month, but kind of flew under the radar here. There was a lot of talk under the Biden presidency about banning non-competes. Well, the FTC got together last month and maybe bring everybody up to speed on kind of somehow something that flew under the radar here.
Yeah. So this back when Biden was president, which actually wasn't that long ago. This happened about a year ago, maybe a little more than a year ago. recall he was the president like 12 months ago.
Yeah.
Seems like Trump's been in a long time. He gets an extended news cycle. Maybe it makes it seem like his term is longer. When Biden was president, his head of the FTC, the Federal Trade Commission, um, issued some guidance and said, "Hey, look, we're going to start looking harder. The FTC is going to start looking harder at non-competes." And they put out a bunch of rules on how they were going to essentially make a lot of these non-competes unenforceable, and force companies to rewrite, if they had non-competes, rewrite them or take them out of whatever employment agreements people had. This, of course, raised quite an uproar for those businesses that have non-competes and use those non-competes to protect their mostly intangible assets they have, the knowledge base, et cetera. Um, so these non-competes, the Federal Trade Commission was looking at essentially very much restricting their use. Now, this has changed. What's happened is the new FTC commissioner has said, "Hey, we're not prioritizing looking at this. We will look at non-competes that violate current law, but we're not making new law on non-competes. We're not going to push what was before an agenda of making non-competes illegal. Still going to respect those as legal contracts. We will go after ones that we feel are breaking the law, but we're not pushing the current non-competes in place in any way like the previous administration did to say that those non-competes are illegal." So effectively what they're doing, the Biden administration, I think, was looking more to open up the labor market and I think right size the value of labor. That would be their argument, and that's done by moving these kinds of restrictions. Whereas under the Trump administration, I think the FTC is now looking more at, hey, businesses have a right to protect their intangible assets, their client bases, et cetera. And that's most effectively done with non-competes. And so we're going to keep those in place. That's my interpretation of how I think each administration is looking at the issue of non-competes. So what was going to be, hey, non-competes, those aren't going to be in favor anymore, and we're going to pursue FTC, that is, we're going to pursue eliminating non-competes. That's gone. So that was big press back then when it was released. Now it's gone, and it actually wasn't big press when when the FTC says, "Hey, we're canning this. We're not going to pursue this." So we're bringing it to you now.
And thank you for doing that. You're right. I think if we look back to what was happening then, there was probably some tariff conversation or something else going on in the news that we were talking about too. So
Right.
I'm glad we could bring this to our listeners now. Eric,
It's
let's go to the. Oh,
yeah.
go ahead.
There's always something going on in the news cycle now. So it makes for a very entertaining podcast all around, I'm sure.
That's why we have a podcast. That's right. That's
That's
why
right.
our millions of listeners tune in every week. All right. So let's move on to our inbox. As always, you can send your questions to bizbeat@sva.com or drop them on our website at sva.com/bizbeat. So this week's question, Eric, it's kind of basic, but it's probably something a lot of people don't understand. What is the difference between a tax deduction and a tax credit?
Yeah, that's a good question. And I do have this conversation every so often, with clients of the firm, and discussing the difference between what does it mean to have a tax deduction versus a tax credit. Some people think, okay, my tax liability is X dollars. What does it mean for these extra deductions? Does that come off my tax liability? Or I have a tax credit against this. How does that affect my tax liability? So the clearest way to say this, I think, is, you know, when you're calculating your taxable, what your tax is on your tax return, you're calculating the income you have and you're adding all that up, and then you're subtracting your deductions to come up with a number called taxable income. And that's what the tax rates apply to. So if you think about the math of the equation, a tax deduction is something that's going to reduce your taxable income. Now, that has the effect of reducing your tax liability, but it's not a dollar for dollar reduction. If your taxable income is 100,000 and you say, "Oh, I forgot about this. I have a $1,000 charitable contribution deduction." And so now my taxable income goes from 100,000 to 99,000. I subtract that $1,000 from my taxable income. That's what deductions are. Your tax is calculated based on a rate times your taxable income. There's a graduated rate system, but in this case, if we just use a flat rate for an example, and let's say your tax rate is 25%, then a $1,000 deduction reduces your taxable income, $1,000. That reduces your tax liability $250, 25% times that tax deduction. So tax deductions reduce your taxable income, which reduces your tax by the tax rate that you're in times that deduction. So it's not a full $1,000 in the case we were talking about reduction. It's $1,000 times your tax rate, $250. So a deduction reduces your taxable amount by that deduction times your tax rate. So it's some percentage. A credit reduces your tax dollar for dollar. So one of the tax credits that's out there is a child tax credit. In 2025, $2,200 per child for child tax credit. And so what does that mean? That means, let's say we get to our example again of we've got $100,000 of income. Let's say your tax is $25,000. So that's your tax rate is 25%, $25,000 taxable income. The tax credit subtracts from that $25,000 of tax. So your tax will now go from $25,000 minus $2,200. So that's $22,800. So it is a dollar for dollar reduction of your tax liability. A tax credit is a dollar for dollar reduction of your tax liability. So to recap again, a tax deduction reduces your tax liability, but it's your tax rate times that deduction, whereas a tax credit is a dollar for dollar reduction of your tax liability.
So long story short, a tax credit is a lot, when you hear those numbers, it's a lot more valuable than a straight deduction.
Yeah, so that when you're thinking of tax credits and, what do those do to your tax liability? A tax credit, a $2,000 tax credit does much more for your tax liability in reducing it than a $2,000 deduction.
Yeah, and I think that's probably something a lot of people don't really understand or know the difference of. So thanks for going over that, Eric. Hey, that wraps up this week's episode of the Biz Beat by SVA. Remember, everybody, you can visit sva.com/OBBBA, 3Bs, for updates on the One Big Beautiful Bill Act and all the content we've been putting on with that, past webinars, future webinars, presentations. And we are still out there in the marketplace giving presentations to organizations, to banks, to law firms. If you or your either membership or your clients would like a presentation on the One Big Beautiful Bill Act, reach out. We'd love to talk. As far as this podcast goes, please subscribe to the show on Apple Podcasts, Spotify, or on YouTube. Share it with a business owner who you think could use a clear summary of what's changing out there. And as always, my typical caveat, everything we share here today is supposed to be general in nature. So talk to your CPA or advisor about your specific situation. If you don't have a good tax planner, a good advisor, please reach out to me. We can talk about how to make you a client. As I said, we're nearing Halloween. It is prime tax planning season. So let's talk. Thanks again for listening, and we will see you next week on the Biz Beat by SVA.
It's the Biz Beat by SVA, breaking down the news of the day. From tax tips to business trends, smart insights from trusted friends.